Welcome back to the deep dive. So today we're tackling what I think is one of the most intellectually compelling challenges in
Oh,
finance.
absolutely.
How do you reconcile a business that is, just executing flawlessly, delivering stunning growth, best-in-class risk management, with a stock chart that tells a completely different story, a story of, well, caution, high valuation, and just persistent skepticism?
We are diving deep into Bajaj Housing Finance, or BAJAJHFL. And we have assembled a pretty dense stack of sources for you today. We've got their recent H1 FY26 financial reports, detailed investor presentations, and a really critical technical stock analysis.
Right.
And our mission really is to synthesize all this information so you can understand the complete picture, the view from the operating floor versus the view from the trading chart.
And we've got to remember the context here. This isn't some long-established behemoth. They only listed relatively recently, September 2024, through a massive 6,560 crore IPO.
A huge IPO.
Huge. And almost overnight, they became this significant large-cap non-banking financial company, an NBFC, focused almost entirely on the massive Indian mortgage space. They're sitting on a market cap of around, 79,000 crore now.
Exactly. And to really get their success, you first have to understand the environment they're in. The housing finance sector isn't just stable. It's benefiting from some incredibly powerful structural tailwinds.
What do you mean by that?
Well, we're talking about fundamental long-term drivers. Things like the government's immense focus on housing, that housing for all impetus. And then there's the rising purchasing power, increased per capita income across the country.
Plus, you still have that lingering post-COVID effect, right? People wanting bigger homes.
That behavioral shift is still very much in play. The demand for larger, higher quality homes is a real driver.
So these factors are kind of the engine for the whole sector, and the scale of it is it's staggering.
It truly is. The sources show the total home loan portfolio in the sector stood at just a staggering 40.6 lakh crore in FY25.
40.6 lakh crore.
And this isn't peaking. The industry is projected to keep growing robustly, something like 14 to 16% compound annual growth rate, a CAGR. That's expected to hit approximately 60 to 63 lakh crore by FY28.
That's immense potential. But okay, let's unpack the dynamics here. It's not an easy landscape. Traditional banks are the big players.
Well, they dominate. They hold roughly 75% of the market share.
So for the housing finance companies, the HFCs as a group, their share has actually gone down a bit recently, hasn't it?
It has. It's moderated. It slipped from about 21.3% back in FY20 down to 18.3% in FY25.
And that's what makes BAJJHFL's story so interesting.
It is, because they haven't just ignored that industry slowdown, they have dramatically bucked that trend. If you look at the period between FY23 and FY25, the overall HFC sector growth was fine, a modest 8.8% CAGR.
Okay, so what was BAJJHFL's growth in that same period?
They delivered a scorching 22.8% CAGR.
Wow.
Yeah, during that exact same two-year window, that is nearly 3 times the sector average. They are just taking market share faster than almost anyone else in the HFC space.
And if you're listening to this, here's a critical insight. Despite all that explosive growth, their overall market share is still tiny. It's just 1.6% in FY25.
Up from 1.0% in FY20.
Yeah.
But still, yes, very small.
That small base combined with that blistering growth rate just screams headroom for growth. I mean, they have a proven playbook and decades of market opportunity left before scale even starts to become a problem.
But high growth is only great if it's sustainable, right? In financial services, it has to be disciplined. So now we need to look under the hood. We need to see if they're sacrificing quality for that scale.
Okay, let's turn to the recent numbers. First half of FY26. The operational achievements in the last year have been, well, exceptional. Their assets under management, their AUM, the total loan book size, it grew 24% year over year.
To 1,026,749 crore. That is top-line execution.
And that scale, it translates directly to the bottom line, to profitability.
It does.
Their profit after tax, or PT, for the half year was the highest they've ever reported for that period, of 1,226 crore. That's up a solid 19% year over year.
In the second quarter specifically.
Q2 FY26 PT grew 18%, but their net interest income, the NII, which is really the core measure of lending profit, that jumped a massive 34% year over year.
Okay, that 34% NII jump is a major signal. It shows they're widening their profitable spread even with all the competition.
Right, but in a lending business, the real sign of quality is risk management. This is the whole cornerstone of their premium valuation argument.
And here's where it gets really interesting for anyone paying close attention.
Their asset quality is pristine. As of September 2025, their gross non-performing asset ratio GNPA was an exceptionally clean 0.26%.
0.26%, and net NPA was just 0.12%.
Just to put that in perspective for you, in the financial world, those are basically best-in-class numbers. A SIO 0.26% GNPA means for every 100 rupees they lend, less than 30 pays is at risk of default.
That's the hallmark of a low-risk, prime and near-prime mortgage book. They're focusing on quality borrowers, and their underwriting is clearly rigorous.
And they're doing all this, the growth, the quality, while getting more efficient. Their operating expenses to net total income OPEX to NTI has been cut to 20.3%.
And management has guided for that to stay stable, right? Around 20 to 21% for the full year.
Exactly. It proves they aren't losing control of costs while they're chasing that 20% plus growth.
And that discipline allows them to pursue this ambitious strategic roadmap they have. Management explicitly states their 5 core pillars: a robust balance sheet, a low-risk operating model, reasonable returns, a full suite of mortgage products, and this is crucial, a diversified borrowing mix.
Let's dissect that product mix, because that seems to be the architecture that allows them to maintain that fantastic quality while still driving 24% AUM growth.
It is. The portfolio is split very strategically. You have the large, low-risk, what they call scale builders. This is mostly prime home loans, about 55.8% of the portfolio. But the other big anchor is lease rental discounting, or LRD. That's at 21.8%. And we should probably spend a moment on LRD.
Why is LRD so highly regarded? What's special about it?
It's the dual security. When they underwrite an LRD loan, the collateral isn't just the property, it's also the underlying cash flows. The guaranteed rental income, usually from a big corporate tenant. It's a very stable stream of income.
So the risk is much lower?
Far lower. It makes LRD practically pristine in terms of asset quality.
So that anchors the quality. Then you have the higher risk, higher yield parts, the return enhancers.
Precisely. That includes developer financing, which makes up 11.9%, and loans against property, LAP, at 10.3%.
And the developer financing is strategic, I assume. It's not just about lending to builders.
Exactly. It helps them build their retail home loan funnel.
Right.
If a developer uses BAJHFL financing for a project, BAJHFL is in the driver's seat to get the retail home loan business from the people who buy the homes. They're leveraging over 8,300 approved projects that way.
Okay, but if they're so disciplined, asset quality is so clean, why is management now strategically targeting higher risk segments? I mean, isn't that a clear sign of margin pressure in the prime segment?
It absolutely signals competitive pressure. They are facing spread compression in that low-risk prime market, so they need to strategically hunt for higher yields somewhere else to maintain their profitability.
And this is where SemHub Home Loans comes in.
Yes, that's the product. It targets the near-prime and affordable housing segments. It's a deliberate expansion beyond the traditional highly paid salaried borrower.
Where are they rolling this out?
They're launching this in 67 urban and 72 Tier 4 and rural locations. It's a calculated risk. Their medium-term plan is to increase their non-prime acquisition mix from the current 14% up to a much more material 20%.
So they are scaling their risk appetite.
They are, but in a very controlled, strategic way.
And all of this has to be supported by technology, right? To manage that risk at scale.
Correct. They're heavily focused on digitalization. I mean, they boast a 94% agreement adoption rate, which is impressive. That's very high.
That digital efficiency is why their long-term goal is so ambitious. They want to drive that OPEX to NTI ratio all the way down to 14–15%.
So let's talk about that guidance for FY26. AUM growth is targeted at a strong 21 to 23%, but management is guiding for their return on equity, their ROE to slightly moderate to 11 to 12%. Why would ROE be going down when they're growing this fast?
This is a critical point that needs unpacking, and it's a perfect example of capital structure dynamics. The moderation is due to 2 main factors, and neither is a sign of poor execution. First, yes, you're right, competitive pressure is leading to spread compression.
And the second factor?
The second is the size of that massive IPO. They suddenly infuse a huge amount of fresh equity onto the balance sheet.
Oh, okay.
ROE is profit divided by equity. When the denominator, the equity, suddenly balloons from a massive cash infusion, it temporarily drags down the percentage result, even if the absolute profit is still high.
So they have excess capital right now. It's a sign of strength, but it momentarily depresses that ROE metric until they can deploy all that new capital. It's a capital structure challenge, not a fundamental execution failure.
So we've got a clear picture. a well-oiled, efficient, growing fundamental business. But the stock chart, as we said at the top, has not been celebrating.
No, it has not.
So what does this all mean for the valuation and the technical story?
Well, this brings us squarely to the paradox. The market acknowledges the strength. That's why the stock trades at over 3.5 times book value.
Which is rich.
By any metric, it's a rich valuation. You are paying a premium that assumes sustained, near-perfect execution for years. This leaves zero room for error, making it really difficult for the stock price to move higher, even with great results.
So the market has already priced in the success, and the technical chart reflects the skepticism that comes with buying high quality at a high price.
Exactly. We see a classic post-IPO digestion phase. The price rolled over from that 120 to 130 zone shortly after listing and has just been in a persistent downtrend.
What are the key technical indicators saying?
The long-term 200-day moving average and the intermediate 50-day, which is sitting right around 102 right now, are both sloping downward.
And why are those moving averages so important?
They represent investor memory. The 50-day, for example, is the consensus price over the last 2 months. When the price consistently stays below these averages and they start sloping down, they act as strong dynamic resistance. Every time the stock tries to rally, it just hits that ceiling of selling pressure. The technical bias is undeniably bearish right now.
I noticed the analysis pointed out a specific high-volume event in early December.
Yes, that was a sharp, aggressive, high-volume sell-off, a volume climax. This is often a sign that the panic selling has kind of exhausted itself.
And then it settled down.
Right. The stock then consolidated in that mid-90s zone. However, and this is the key, while selling pressure has eased, we haven't seen visible, high-volume accumulation investors piling back in. The price is just sort of drifting, waiting for a catalyst.
Is there any technical signal at all that suggests the selling might be ending?
There are subtle hints. What we'd call a mild positive divergence in the 14-period RSI, the relative strength index.
Meaning,
While the price made similar lows, the momentum indicator was ticking slightly higher. It suggests momentum exhaustion is happening. But, and this is crucial, the RSI is still below the neutral 50 level. Technically, there is no confirmed bottom. This is still a high-risk technical play.
So for you, the listener, what are the actual levels that would signal a real shift in market psychology?
You need to focus on that Euro and 2 level. That's where the 50-day moving average is right now. A reliable reversal signal needs the price to break and, more importantly, hold decisively above Euro at 2. And it needs to happen on strong, renewed buying volume.
That would signal the short-term trend has shifted.
Correct.
And until that happens.
Until that happens, any accumulation near the current 95 to a Euro at 100 zone requires a very conservative approach. Because this is a new listing, there's very little historical price support below the December low. So if it breaks down from here, the downside could extend pretty quickly. Tight stops are paramount.
Which circles us right back to that central tension. You have a business delivering industry-leading AUM growth of 24%, maintaining an astonishingly low GMPA of 0.26%. It's backed by structural tailwinds, digital efficiency.
And yet the stock is derated about 25% from its peak.
Reflecting only the reality of those high valuation concerns and that technical downtrend.
That is the complete picture.
Yeah.
You now have the knowledge of this immensely powerful fundamental growth engine, but that engine's power is currently being neutralized by the financial reality of the high premium multiples the market demands and, the inevitable competitive pressure on spreads.
It's the classic challenge, assessing high quality when it already carries a high price tag.
It is. And as we finish this deep dive, consider this provocative thought. BAJHFL is betting it can successfully scale its high-yield non-prime SOMHAV segment to 20% of its acquisitions. They are deliberately adding complexity to protect their margins.
It's a high-wire act.
It really is.
Yes.
If the company proves it can execute this, if they reach that 20% target without compromising its best-in-class asset quality, which they say will only edge up to 35 to 40 basis points GMPA, how much longer will the market be able to ignore this proven combination of risk management and high growth when it's assessing that rich 3.5 times book valuation?
It's the ultimate test of strategy versus skepticism, a fascinating dynamic and certainly one we'll be watching closely. That was the deep dive on BAJJHFL. We'll see you next time.